Hello, everyone, and welcome to this webinar about the Eurozone economy. I will just hold off 3 or 4 minutes and let everyone join in, and then I'll start the presentation. So there's always some of you who have issues with the audio on the day or the recording. And so in order for to legislate for that, what's going to happen is this is being recorded, so you can always go back and listen to it, and so hopefully that will help you. But anyway, I'll go through that as I start. Anyway, I'm going to just put everyone on mute for like 2 or 3 minutes and let the last participants trickle in. Thank you very much. Once again, to the people who are just joining, I will begin the presentation in a couple of minutes just to allow the last participants to join. Thank you very much for holding. All right, I think we're ready to begin. Just a couple of two bookkeeping notes before I get into the presentation. As I said a little bit earlier, this recording and this presentation will be recorded and will be sent out so that you can also follow as I go through the presentations. Some of you might not have the presentation in front of you. It was sent out before, but if you don't rest assured that I'll go through and I'll describe what's on the chart. So if you don't have it, that's not a problem, but then you can go back and listen to it. Also, if you have issues with the audio, or if there's others the technical issues, you can always go back and listen to the recording. I will also do a Q&A at the end. The way this works is that if you're logged in, you'll be able to ask a question, and I can then and I will answer that question at the very end of the presentation. If I don't get to that, or if we start going going too far in terms of taking up too much time, please, send me an email afterwards. I'll have a call with you to catch up on some of these issues. So that's not a problem. In any case, there's a lot of ground to cover today, and in some sense, I feel that I'm coming to you about the Eurozone economy at a sort of a critical juncture in both in terms of the Eurozone cycle and expansion, but also in terms of the story told about the Eurozone, in terms of what policymakers are saying at the moment, in terms of what investors are saying at the moment. So the way I've split this presentation up is I'm going to talk about the economy, obviously, and in doing so, I'm going to try to separate out the two main stories that have been gathering investors and economists' attention on the Eurozone basically for 6 months. Namely, what is the split between one-off factors that have impeded growth and things that are real. I think because I think that is worthwhile doing, except just to state the obvious. If you have 10 one-off factors, obviously they tend to become something real. So once you get to the extreme, the distinguishing one from the other is obviously difficult. But if you just look at some of the, if you just look at the first set of slides here as we start to talk about the economy, Q4 really was about Italy and Germany. And I think this story hasn't gotten enough press, really. I mean, if you look at the Q4 GDP numbers such as they came in the second estimate, basically everywhere else but Germany and Italy was okay, but you had a very, very poor performance in those two economies. Italy is now officially in recession, and Germany basically stalled. I mean, it's possible that Germany was in recession in the second half of last year as well. That will depend on revisions, but such as it is, Italy and Germany were very poor, and are both basically why in the second half of last year we had such a precipitous decline in the hard data. You look at leading indicators, they are, as always, mixed. If you look at the January PMIs and general January survey data, they're really horrible. So they suggest that, and to some extent, the weakness that persisted throughout the second half of last year was carried over into the first half of the year. I mean, this week I think is absolutely crucial. We get all the major surveys on Thursday. We have the ECB out with strong dovish comments, and so those Thursday surveys will just be watched like people will just watch them very closely. Just mean reversion is starting to favor a rebound in some of these indicators. If you look at where the macroeconomic surprise indices are, if you look at where the surveys are compared to where financial markets are at the beginning of the year, we should start to see some stabilization. But again, anything can happen in a given month. On Thursday, just to preview that particular barrage of data, I would focus on one particular data point, the French services PMI, which was absolutely out of whack compared to the National Statistical Office's data in January. That was one of the reasons why the composite index in the Eurozone was so poor. The German IFO was bad as well, so it wasn't just the French services PMI, but that in particular was one of the outliers to the downside. By contrast, if you look at the trend in real money growth, and those of you who have followed me for a while know that is an indicator I put quite a lot of emphasis on, because it is one of the best empirically leading indicators for GDP growth, and it's pretty much suggests that growth is slowing, but it's not in free fall to the extent that we saw in the second half of last year. So I think the story from this indicator, which is kind of like where I'm basing my forecast on, is that I think there's room for a pickup in the first half of the year, solely based on leading indicators. But then I think we'll slow again towards 0.2 to 0.3% quote unquote on GDP towards the end of the year. That gives full year growth of about 1%, which is very low. But as I've explained a lot in my writings recently, that is almost only because of statistical carryover effect from a weak finish to 2018. And by now, this really ought to be consensus. I mean, I had a good time telling that story earlier at the beginning of the year and at the end of 2018, but I don't think I can dine out on that story anymore. It is in the forecasts. It's in the Commission's forecast. It will be in the ECB's forecast by March. So really, I think this shouldn't be a story anymore. We're at 1% for the Eurozone as a whole, 1.1% in Germany, 0.4%, 0.3% in Italy because of a recession, and that's it. 1.3% in France and a little above 2% in Spain. That's consensus now, and that gives you about 1.1% in the Eurozone as a whole. The final chart here is political uncertainty. I'll come back to the political risk, but just to say that political uncertainty is great to talk about, but it's really difficult for economists to quantify. And I would even say it's also difficult for strategists to quantify. And by this, I mean, yeah, sure, you can find some relationship perhaps between quantifiable measures of political uncertainty and equity multiples, for example, stuff like that. But it's really difficult. So we have this nebulous idea of political uncertainty, but to actually map it back into the economy is actually very difficult. There's no reason to expect, for example, that the fact that the PMI has rolled over so much as it has in the last 12 months necessarily has anything to do with political uncertainty. At least not if you look at it the way it's described here. So that's the overview, and so let's start with the bad news. Manufacturing in the Eurozone is basically falling off a cliff, and as I'll mention when I get to the next slide, some of this is one-off, but there are also real economic slowdown coming here, and it is China and external risk. That's really where it's coming from. The Chinese manufacturing cycle has basically also completely rolled over, and that has a very, very strong feed through into the Eurozone economy. It hits the Eurozone before it hits the US data and the UK data, I'd say, but clearly we now have very weak growth in manufacturing compared to a story just, I'd say, 9 to 12 months ago where everything, was all guns blazing and we were talking about capacity constraints. Again, it's probably in the price by now. The Q4 data were really poor, and as you can, and if you look at the comparison between the hard data, this is to say industrial production growth in December and November compared to the surveys, the industrial production data are now undershooting significantly. So that's the good news. The bad news is that when you have a precipitous slowdown like this in manufacturing, in production, and it has been sustained for a while, then we start to map it into slower investment growth as well. We also start to map it into a lower growth in equity earnings, insofar as goes that there's a sales and earnings component as well in the headline macro data. In some sense, I think that's quite again, some of these stories are by now, I think, should be in the price, especially the equity earnings story. I'd say that again. I think that the word of the week last week on Bloomberg TV was an earnings recession. So it seems like everyone is kind of already on board with that. So there's not much news there. But with investment, investment in the Eurozone in machinery and equipment has basically been growing steadily at about 5%. That's a little bit difficult to expect that to continue with production growth as weak as it's been. So there's a little bit of downside risk there. And then of course, if you look at China, it's really frustrating at the moment because what's going on in China is that they're throwing the kitchen sink at the economy. So we're now supposed to look at the Chinese liquidity numbers and the trade numbers and the PMI numbers very closely, obviously, for sign of stabilization, except this is Q1. So everything in China gets completely mauled in Q1 because of the Chinese New Year. So I actually, speaking to my colleagues, Freya and Miguel, who write about the Asian economies, and we might not know anything for sure until April, and obviously that's quite frustrating because it is really an important swing factor at the moment for manufacturing in the Eurozone. So manufacturing is weak, and that is certainly, there is something real there. All right, the next point of order is the one-off effects. Just brace here because there have been a lot and they keep coming up, and it's really difficult to get a hold of all of them because they're very different. The first one I'd mentioned is actually one that there hasn't been a lot of talk about in sort of the general discourse is Ireland. It seems to me that the Irish economy basically fell off a cliff in Q4 on a quarter-on-quarter basis, which is not unusual for Ireland to have these kind of volatile swings. What happens in Ireland is that industrial production swings wildly on the basis of what happens in what they call the modern sectors, and the modern sectors include pharmaceuticals and electronical equipment. And I don't have to mention the kind of companies that are involved here, but it's just a very big multiplier for the Irish economy, and that again feeds into the Eurozone economy. And basically, I think Irish industrial production crashed almost 10% quarter on quarter in the fourth quarter of last year, and that had an additional impact on the Eurozone industrial production figures above and beyond what I suppose is the main one-off factor that we've been talking about, namely this idea of a shift in EU emissions regulations and a hit to auto exports and auto production. This is not a presentation about the auto sector. I might actually that's an idea for later, because there's a lot of stuff going on there. All I'll say is that it seems to me that the extent to which the industry had a big inventory overhang at the end of Q3 and a very, very poor performance in both production and export, it seems to me that some of these factors are now fading a little bit, so that maybe production is starting to recover a little bit. I mean, all we can say is that new orders in Germany, factory orders and production rebounded quite strongly in December, and the new orders to inventory ratio on the IFO suggests that was sustained at the start of the year. But these data are volatile, but it seems like we are close to a sort of an intermediate bottom here. Then there's the other one-off that has been in the news a lot is this idea of low water levels on the Rhine, which is, I mean, a little bit ridiculous actually that we have to talk about this. So the only thing I'll say as an economist, because I'm obviously not an expert on climate change and any other thing, is that it seems to me, if you go back and look at the historical data, when the water levels on the Rhine, which doesn't happen very often, but when that falls below 1 meter, measured in this case at Kaup, which is a small German town on the Rhine, then basically the river barges can't operate at anywhere near full capacity, which means they can't transport goods and fuels, and that therefore you get a supply shock in the German economy. Right. So that's obviously a great little story to tell over the dinner party, but it seems to have been fading. It seems to have been reversing quite quickly towards the end of the year and into the new year. And also, as far as I've been able to understand, one of the reasons why this was such a big problem this year is that all the companies that tried to, a lot of the suppliers and companies in general, distributors that tried to shift their production into road couldn't do it because of a lack of permits. Now, again, if this is a seasonal pattern, it is a seasonal pattern, and if this is going to be a more frequent seasonal pattern, we would expect that next year they would have figured out to have more road permits, so that for a temporary period, maybe it would be possible to shift production away from this, so that this is not something we have to write about every time we hit Q3 and late Q3 and early Q4 numbers. But anyway, we'll watch it, and as ever. But I would say that it shouldn't be that much of an issue going forward, because they really should be able to correct for it. But it's a thing, and it certainly was a thing for the data. The final one-off that I want to talk about here, in terms of the clear one, the one we can find in the data, is the huge volatility in production of German pharmaceuticals and chemicals. The story is that this is due to the reporting of one or two very large companies where production ran up in very, very strong in the first half of 2018 and then fell off a cliff at the end of the year. A couple of things usually happens in pharmaceuticals sectors when this happens, which usually is to do with inventories. Inventories probably was a drag on Q4 GDP, so maybe there's going to be a hint there. But we'll know that on Friday when we get the detailed numbers. But I think it looks like that one-off effect also is reversing. So that leaves us at the start of 2018 with start of 2019 with, as far as I can see, most of the one-off factors reversing, and also, in my view, some upside risks to the economy, at least on a sequential basis, such as on a quarter-on-quarter basis going forward. I mean, the most important one really, for me, is the Eurozone consumer. So what happened last year, and this again, where we have to distinguish between what is sustainable, as what is a sustained structural shift, and what is one as a one-off. But basically, what we can say is last year we saw a big increase in the savings rate. We saw a hit to real wage growth because headline inflation rose faster than nominal wage growth, and that basically dragged consumer spending down. It also dragged consumer spending down to such an extent that by the end of Q3, for example, consumer spending in Germany on goods was falling year over year. Now, that really doesn't make any sense compared to underlying fundamental for the consumer in the Eurozone, which is unemployment still falling at a slower rate than it was, but it's still falling. The growth rate of household assets, which basically, remember, household assets in Eurozone are not equities, they're basically house prices, and they're now increasing in most of the major economies. And deposits, and in general, because interest rates have gone down, so to the extent at which you've owned deposit securities and bonds, especially in Germany, that's also gone up. Although, of course, you don't get as much interest rate on the reinvested earnings as you usually got. But I mean, the ECB series for these kind of data are quite positive. And because of headline inflation now falling, you have real wage growth probably picking up a little bit again, because nominal wage growth looks to be relatively stable. So that actually gives you a pretty positive picture for consumer spending in the first half of the year. I would particularly be focused on France, where what they in France called, I mean, it's basically the purchasing power, which is real income, but that's a big thing in France. And because of a high minimum wage, tax cuts, and a much lower headline inflation rate, it seems like that the support for consumer spending in France, in particular, will be very strong, and base effects here look quite significant for a rebound consumption. And that should also take a little bit of the sting out of the yellow vest protest. Although, again, I would have mentioned the yellow vest protest as a source of one-off effects to the economy, but I've got to say it seems to me that the actual real economic effect of these protests were very, very slim in Q4, even though the survey data in consumption were absolutely horrendous. But it doesn't seem to have had any additional impact on spending that wasn't already sort of flagged by slowing growth in income. So consumer spending in Germany, consumer spending in France, have a look at them in the first half of the year. I think that's where we should see the most upside risk. Also in Spain, where the minimum wage also have gone, although there's a little bit of uncertainty about that because of the new election. I also think that construction is in generally on a decent footing in the Eurozone, although the data have been very volatile recently, as they are, and some of the surveys have gone up a lot and they've gone down a lot. Again, I think the French economy probably is the most important to watch here, because what happened last year in France was that basically construction investment slowed. I mean, so in 2017, construction growth in France was rising by 4 to 5% year over year. It slowed to 1.5% last year, and part of it was, the main reason was a collapse in housing start building permits, mainly because of a shift in tax rules on a new property, and especially buy-to-let investment and sort of large property developed in the residential sector. Again, this is a one-off. This is not going to come every year. Of course, I would expect some of that data to improve as well. So, I mean, as you can hear, there's an underlying theme here, namely that the French economy, actually, I see a lot of good news ahead for the French economy, following what has been sort of a very tumultuous period insofar as goes the domestic economy. In Germany, I think consumer spending should do all right, but I think manufacturing, unfortunately, at least in the short run, it still looks like that is going to be under pressure. So now we get into the inflation story, and we get into the ECB story, which is separate, and I think it's really, really important at the moment, because I think that we are I mean, we're close to an inflection point in either direction. I'll discuss that a little bit. First, one thing I just want to mention in terms of the labor market is that because growth slowed as much as it did last year, this is sequential. We started the year at, I mean, 2.5, and we ended the year at 1.4 or 1.2 in the Eurozone as a whole. That means that employment growth will slow as well. That is what I am showing in the charts number 17 and 18. If you can't see those charts, don't worry. They just show that the year-over-year growth in GDP tends to lead year-over-year growth in employment, which is the equivalent of just trotting out what everybody knows, namely the labor market lags the economy. So just expect the labor market data to deteriorate a little bit insofar as the rate of improvement will come down. That's also why this year in the Eurozone, I only expect unemployment to fall to 0.6, 0.7%. It's no, sorry. Stop. I expect unemployment to fall to 7.6 or 7.7% from its current level of 7.9%. So not a lot of extra decline this year, as because of the lagged impact of slower growth, slower GDP growth last year. Right. So breathe for a minute, and then we get into the inflation data. There are, again, as always, two stories in the Eurozone inflation data. There's the headline inflation story, which is now being driven by base effects in oil. Headline inflation is going to fall more, and mainly because energy inflation is going to fall more. I think we're going to hit a bottom in March, because by then, obviously this assumes oil prices don't shoot up, but what's going to happen in March is that if oil prices remain at their present low level, you're still going to have low energy prices. You're also going to have two other effects. A big increase in French tobacco inflation will fall out. So basically right now, inflation in French tobacco are rising about 15% year over year because of the tax hike in March. That's going to fall out in March. And then we get to the Easter effect, which is going to be wonderful, wonderful. Again, this year, we have a very late Easter this year compared to a relatively early Easter last year. That's going to screw up everything in the CPI data in March and April. So just do not tell me that you weren't warned about this. It's going to screw up everything. The March CPI data are going to be severely depressed by this because of package holidays. Now, the ECB won't have this data when they do their staff projections in March, because they do them in the beginning of March. So it might not affect the story that much, but just make a big asterisk of this, because it is going to be, I think, it is going to be what it is, and it's going to be quite. I think it's going to be quite spectacular in terms of how much these data are going to swing. So, other than that, you look at core inflation. Core inflation is very unthreatening at the moment from the point of view of the ECB, insofar as it's low. It's not going up anywhere fast. It is probably going up, but it's going up less than the ECB expect, which will again create this odd situation that the ECB, when they meet in March and do the staff projection, they'll almost 100%, with 100% certainty, they'll downgrade their GDP forecast, and they'll probably also notch down their core inflation forecasts a little bit, because they forecast an average, and I think by then they'll realize that they're a little bit behind the curve. Although it's early, so they might maintain them, but my best guess is they're going to downgrade them again, which is a nice segue to discuss the ECB in general. At the moment, the ECB clearly is building on if you look at the comments from the ECB at the moment, such as they're coming out at the moment, they're building on the dovish shift at the last meeting, where you had this ephemeral shift from balance to downside risk. That was a clear indication that the ECB is a little bit more worried about the data. Comments since then from Benoit Cœuré, Peter Pratt, and basically Villeroy as well. All of them, save Draghi, have kind of confirmed that that the ECB is now in a mindset where this idea that they're going to automatically hike rates in the second half of this year is basically off the table, such as it is now. Then there's been talk about TLTROs. I'll just hold off a little bit on discussing them, because I'll go back on the rates a little bit, because the flip side to this story is that basically that has been priced in for 6 months, right? I mean, the market has been pricing out the ECB for the last 3 to 6 months, and it basically started when the market threw a tantrum in Q4, and by then we already knew the economy was slowing. So by then the market, Euribor futures and the overnight interest rate spread market. So from a market perspective, I'm not sure how much emphasis we should put on these ECB comments, since they merely seem to be confirming what the market is already telling them, namely that the market does not believe that they'll be able to raise rates this year. Which then brings us into the window of opportunity, which is Q1, Q2 data. Is there a likelihood that those data could move the needle enough to shift expectations towards a rate hike, one deposit rate hike in the second half of the second half of this year by 20 basis points to minus 0.2%? My answer to this question is yes, there is. I think with bond yields at 0.1%, and where given the dovish pricing we have at the moment, all the risks are towards a shift in those expectations, because the alternative is an extremely pleasant place for everyone, right? This is the place where you have Goldilocks, you have bond yields are going down, you have equity prices going up. It's a story in which the ECB is dragging along the same lines as the global central bank community, which is posing this very, very benign story. And I'm not saying that can't persist. That is where we are at the moment, and it's a quite pleasant place. But it's right now risks are increasingly tilted towards a different outcome in the next 2 to 3 months as we get into spring and into the second half of last year. The big unknown is also how will the ECB talk about wages. Most of the charts I have here to talk about the ECB is about wages, because that insofar goes that the ECB still has some kind of slightly hawkish story running around in the back of their models. It's all based on wages, which are going up, and the output gap probably is being closed to a large extent now than it was. So that again will inform them. But they've pulled back a little bit on this, and to just go back to one of the structural stories I have, I mean, they're missing the inflation target. They're missing the inflation target because while wages probably is pushing up services inflation, I mean, they are basically price takers of non-energy goods inflation, which is 40% of the core. And if you look at goods inflation, non-energy goods inflation, risks are tilted to the downside now, because the Chinese PPI is in free fall. So by the middle of by the end of this year, you could have non-energy goods inflation actually lower than it is now. So the question then we have to ask ourselves is that will the ECB get into a situation where they do this technical adjustment where they say, look, we're going to adjust the deposit rate towards zero, and we're going to compensate for that by extending forward guidance, basically lower rates for longer, which again, that has to be the story. I mean, that is the story. I mean, we're having a big discussion here about 20 basis point on the deposit rate from minus 0.4 to minus 0.2. And I mean, recent meetings I've gone into to readers, and I've suggested this, and I've been met with comments that this is like Trichet and the same kind of policy mistake. I'm like, well, if that's where we are now, I mean, where's the fire? I mean, the rates are going to remain low for a very long time. That's the base case. So now we have to look at where I think investors now have to focus on where the risks to that story could arise. Wage growth is one of them. The sort of technical adjustment in the deposit rate towards zero, compensated for by other policy tools, is another thing. Although again, I think if you listen to Benoit Cœuré, who came out earlier this week, he kind of poured cold water on this, because he said that he wasn't a fan of the idea of increasing rates now so you can lower them later. But then again, Benoit Cœuré is also leaving the ECB potentially, although he could get dragged back in as a president, we don't know. But again, so there's a little bit of uncertainty exactly on what the ECB thinks here. But I think that if you go to sort of the main sort of pillar of compensation, if you want, in terms of if they would like to get the deposit rate away from the minus 0.4%, you've got the TLTROs, and I think there are three points to mention on the TLTROs, which are absolutely important because, and I think really that has to be sort of the baseline for the TLTROs, because there's going to be a lot of talk about these things in the next couple of months, and these things are technical. First thing is that an extension is now a foregone conclusion. And what do I mean about this? I mean that while some of them run out this year in terms of you only have 1 year left, which means they can't be calculated, they can't be used to satisfy capital requirements. So that could hurt some of the smaller banks who have taken up these liquidity operations. I don't think the ECB would want to do that. So an extension is a foregone conclusion. An extension on the same terms, which basically mean at zero or the deposit rate, if you can lend it out to the real economy. That's basically the way that it's been working out so far. So I would expect that them to extend that along the same lines as they're still going to reinvest QE, right? Principle from maturing QE bonds. It's the same principle, effectively, as far as I can see. So my call is definitely an extension. I'll be very surprised if they don't extend the ones that are already there. Okay, second part of this is that they can do new ones. They could do new ones, new TLTROs. This is a new targeted LTROs, which basically is a new round of liquidity where you say the same thing to the banks as you've been saying up until this point. Here's a pool of liquidity. You can take that liquidity, and if you lend it out to the real economy after a period of time, you might get a bonus in terms of you might get the funding at even negative interest rate, or at least at the minimum at 0% interest. Of course, if you don't, you might take a penalty as well. But I mean, I don't think they would ever enforce penalties. So that's the way it works at the moment. Okay. Yeah, I can see why they would do that, but I'm not very excited about this because TLTROs basically boosts the capacity to lend in an economy where the demand side probably is curbed anyway. I mean, if you look at nominal credit growth in the Eurozone, I mean, it's growing in line with nominal GDP. I mean, mortgage, consumer credit, non-financial loans to the non-financial sector. I mean, it is growing. It's growing at 3 to 4%, depending on which numbers you look at. And I'm not really sure you can boost that market much more. Maybe as non-performing loans roll off, maybe in Italy and Spain, you can get it up. But I'm not particularly excited about this, mainly because the original TLTROs, in terms of boosting lending, in my view, doesn't seem to me that they've been hugely successful in terms of boosting lending. Although again, I don't have the counterfactual. That's the second part. New TLTROs, again, I have no objection to this. But really, what we need to look at is forget about the LTROs. The original LTROs in 2011 was basically unlimited liquidity to the banking sector, and they could buy whatever they want. Effectively, they could play the carry trade in sovereign bonds. That could be a very, very powerful tonic, especially in Italy, because Italian banks are already coming back to the BTP market. And if they get extra liquidity now from the ECB to buy BTPs, we're in business. It's difficult for me to see how they would do that. And in any case, this is something that is going to be, that's going to take quite a while for them to hash out. When I say quite a while, I mean, we won't know until the middle of the year. So it's not something that's going to come out in the short run, I think. But again, in terms of the different stages of the TLTRO, I think again there are three. Extension for sure. New ones under current conditions, yeah, maybe. I'm not so excited about that, but surely at the margin it would help. New liquidity operations altogether that can be used to buy sovereign bonds, then that would be, or external lending if you go even further, but that would be very naughty. Then I think we're definitely in business. And the final point I've mentioned on the ECB, and this is really, in some sense, the biggest point of them all. And I've in recent meetings with readers, I've escalated this issue to a problem. Namely, the problem is that I'm an ECB forecaster, and I have absolutely no clue who's going to be the president or the major policy-making individuals in the second half of this year. Right, that is a massive problem at the moment. What I do know though is that they have to change forward guidance in June. I mean, at the latest, because they have to tell us what through the summer of 2019 means. That again goes back to the original point, namely that no matter how Draghi and Correa, and I'm mentioning these two because I think those two are kind of like the main drivers of what's going on in ECB in the moment in terms of these kind of policy tools. No matter what they say, they are going to pre-commit a future president to that path, given that they're leaving in September and December respectively. And that just means that talk is cheap now. Now, that doesn't mean that they won't be able to sway the market with what they say, but up until the point at which we know who is going to be the next president, I have to say we're driving blindfolded here, and that I don't want to say. I mean, it's a problem. It's like, please understand what I'm saying. It's not a problem to the extent you should go out and sell everything you own in euros and that type of problem. It's just a point of contention now, because it would be really nice, right, to have it all sorted by the end of Q1 or something like that. But I don't think it will be, because the ECB president that position is going to be decided alongside probably the new EU Commission, and that won't come until after the elections, the European parliamentary elections, and so that means we probably have to wait up until the point at which they have to change until we know who it is. And yeah, so that's an issue. That's an issue. I can only assume that in this environment, this really goes back to what I said before about where risks are tilted, is that I think markets are going to no, let me put it like this. I think markets are going to adjust its interest rate expectation a little bit more compared to where the data is going than to what the ECB says in March and going forward in Q1 and Q2. So that would be my message to you, is I think, if the survey data pops at some point in Q1 or Q2, I think interest rate expectations are going to move a little bit more than they would have otherwise been, because whatever signals we get from the ECB, it's a little bit like, well, I mean, can we really? I mean, I think status quo has to be the base case. Status quo basically means forward guidance and QE reinvestment, those type of things, but we don't know. Right, that's as much as I'll say about the ECB, but then we can kind of like, I just mentioned the European parliamentary elections, and that takes us into political risks in the Eurozone, which, again, as I've said, they're difficult to quantify. There are two main risks which are politically related now, but could also have like a quantifiable, I'd say quantifiable economic effect. One is Brexit, and the second is tariffs on European cars. The question I'm starting to get at the moment is what would a hard Brexit mean for the Eurozone economy? Well, hard Brexit means recession in the UK, planes are not flying, we have lorries on the M25, these kind of things, which are quite unlikely. These things, this is very, very unlikely, I would say, that happens. And the reason I say this is the EU's already taken steps to make sure that doesn't happen. So in some sense, a hard Brexit, actually, just to say a nightmare Brexit, is actually very difficult to implement. Right? It's difficult to implement because steps will be taken to assure that it doesn't happen. So I think the real downside case here is actually quite it's not a big risk, even though you might have a no-deal Brexit. I think that is as clear as I can get. I still do expect a deal. That's what we expect. We expect a deal to be made. Although with the recent defection of some Labour MPs, we've also increased our probability of a general election this year, because history shows that if Labour splits, it makes it much easier for the Tories to gain an actual majority in a first-past-the-post system. And well, maybe second time lucky for May, right? When she didn't get the absolute majority in the first round in 2017, but she might get it if she goes for it the second time. That's not our base case, but just again, I think that's increased the risk a little bit. Tariffs on autos, I'm also getting a lot of questions on this. First of all, the trade here is simple, right? Let's first, as an economist, the only thing I'll say is that if you get 25%, 25%, like if that headline hits 25% on EU cars, you're selling the euro. all day long. This is Trump. This is the curse of Trump. He can win the trade war, but he's going to have a strong dollar right up his backside. This is what we've seen up until this point. This is the way the market has traded the trade war with China. And I can't guarantee anything because this is currency markets, right? So scrap that. But I would be very surprised if the euro didn't sell off on a measures like this, because Germany is already weak. He comes in 25%. I mean, you're selling the euro all day long. So I think the euro, so what I'm saying is, if 10%, the euro could take out that to some extent on the, I mean, this is say Trump comes in with 10%, the euro goes down 10%, same, but different. This is the same story we've had with the yuan, by the way, and I'm sort of taking that and adjusting it over. Other than that, obviously, that would be very, very bad for the European car industry, which is already probably peaking. I mean, if you look at all the data in the Eurozone car industry, the cyclical data and the structural data, it looks like we've hit a cyclical peak. Car sales are rolling over in terms of both level and in terms of momentum growth. And if you look at growth in China, I mean, the Chinese car sales data this week they were absolutely horrible, and I think that those things are, I mean, they are more persistent than just that. And then, of course, you have the structural parts of this story, which is a shift towards electrification, different type of business model, away from the internal combustion engines. I mean, the best way for me to explain this as a macroeconomist is that I look at the auto sector now. It looks to me from top down as a sector with overcapacity in increasingly obsolete models and capacities, right? So it just seems like that's why markets are pricing these companies the way they're pricing them, and from a macro perspective. And that's probably not going to change in the very short run. That was probably as far as in terms of political. There's also like Spain and Italy, these kind of, I mean, the Spanish election, I'm not going to say much about that, because I think markets, to the extent that markets care about European elections, they only care if there's one or more countries parties that are going to come through as going to threaten to leave the Eurozone or leave the EU and things like that. That ain't happening in Spain. This is an internal issue about Catalan independence, which I will not have much to say about in this presentation. If you want to talk about that, you can send me an email. But I don't think that's necessarily an issue for the European markets as a whole. And the European parliamentary elections, again, we're a little bit far away, but in terms of all the populists and this idea that we're going to have a populist wave, I mean, I take a very cynical view on this. It's like, absolutely, let's get them in, let's get them around the table, sit down. That's the best way to curb the power of people who want easy solutions. And I'd rather say that than populist, because populist denotes this idea that if you're doing what people want you to do, you're not doing the right thing. I don't like that idea. But this idea that you can just wave a wand and then everything is fine, and do sort of a few things, you close yourself off to the outside world, things like that. I mean, get them to the EU, sit around the table. Actually, I think it'll be much less of a risk factor for markets than some investors expect. And actually, just as I am here now, because I'm getting a couple of questions in, and one question is about the drivers of Eurozone underperformance, where the point here is that is being driven mainly about underperform in the external sector. And that's actually, that's a really good point. I think, and that I stretch that point to explain why I don't think, stick my neck out and all that. I don't think that we're heading for a Eurozone-wide recession at this point. I don't think the momentum is going to deteriorate to such an extent that that's going to happen. And by the way, this has nothing to do with the central bank put from global central banks or for the ECB, because they won't react to these things in time anyway. They'll come in afterwards and increase the recovery. No, the point is that the Eurozone normally suffers a recession when you have a combination of two things. One is certainly the fact that you import weakness from abroad. That's certainly the case now. A lot of what's going on now is the Eurozone is importing weakness from abroad, weakness in manufacturing, weakness in trade, uncertainty in trade, weakness in China, weakness in the UK, because the UK is the biggest. I mean, it's after all a huge trading partner, big that they run. big trading partner for the Eurozone. So the Brexit uncertainty has hit here as well. So that's certainly one of the, so that's Eurozone will can face recessionary conditions when you import weakness from the global economy. But there's another thing that usually also happens, namely that short-term interest rates in the Eurozone usually go up, on a sustained basis by 12 to 18 months before a recession. And what that means in sort of more simple terms is that usually the central bank is raising rates before the recession comes or is moving to tighten financial conditions. I don't think what we've seen from the ECB so far, basically ending QE, you're still at negative interest rates, you still have a very loose monetary policy setting on all accounts. I don't think that's enough on a domestic scale to tilt the domestic economy into a recession. And specifically, just to mention a couple of things, rates on consumer credit, rates on loans to the household sector are not increasing. The extent to which households have variable rates on mortgages, which most households in the Eurozone, they do have, and this is their biggest asset, they're not going up. They're all tied to Euribor. Euribor rates have fallen recently, actually. I don't think 20 basis points necessarily on the deposit rate is going to make a big difference on that if it comes next year. You look at firms, you look at the liquidity, the available liquidity on deposits in the non-financial corporate sector is very, very high. It's concentrated, but it's very high. So there's no liquidity squeeze in the Eurozone domestic economy that would suggest that we're hitting the same type of recessionary conditions we saw in 2008, 2000, and 2012, where it was really severe. But those kind of slowdowns were preceded by actual contracting liquidity. Liquidity growth is slowing, but it's not contracting. So that is kind of my mindset about where the Eurozone economy is insofar as goes, that we're probably slowing to a measure of trend, which is probably 1.2% or something, 1.3, depending on how nice you are in terms of how much spare capacity you think is available. And the only thing that could make me change change my mind on this is obviously, if you start to see different language by the ECB, or if you start to see one of the peripheral countries start to open up current account deficit. Spain is a little bit interesting here because the current account surplus is actually falling quite a bit, but that would then take us back to a 2012 type scenario. Not as bad, but this idea that if you start to rely on foreigners to fund investment and consumption, rates will go up. Probably rates will go up. That makes sense, right? Especially in the Eurozone where you've had experience like that before. But the Eurozone as a whole, I mean, the numbers came out today. Yeah, the current account surplus has declined, but it's still like 2 to 2.5% of GDP. So it's not like it's small, and of course in Germany it's close to 8. So, you still have surpluses in the periphery and in Germany. So that's why I struggle with the idea of a sort of a free fall in the Eurozone economy, at least in the domestic Eurozone economy. And then above and beyond that, again, which is fair enough, going back to the question that was raised by one of the listeners here, is that in the Eurozone, we are price takers of the cycle and the global cycle, as it were, and that's certainly weakened this year. And the final part of the presentation basically is just a recap of some of the French and German data. I don't think I'm gonna go too much into them because I've already spent a lot of your time, but just to recap, there's been one-off factors, there's been real factors. The real factors is, as we've just talked about, clearly the external sector is much weaker. Then you add a lot of the one-off factors, especially in manufacturing. They appear to be fading at the margin now a little bit, going into the first quarter and the beginning of the year. In the domestic economy, I think consumer spending is going to pick up in the first half of the year, and indeed over 2019 as a whole. This is where I'm hanging my hat in terms of things going to improve a little bit. So if we don't see signs of that, I'll have to concede defeat. I also think construction is going to do all right. There's another thing we haven't discussed here: fiscal stimulus, because it's one of those things that I think the narrative has changed. Right, Germany is now alone on the hill with its massive fiscal surplus, and nobody really thinks that's a good idea, but it takes a long time for that to move. We are getting tax cuts in France. We are getting high minimum wages. I think we're going to get some tax cuts maybe in Germany later this year, but it takes a while to feed through. Finally, the Italian economy is also going to get a fiscal boost this year from emergency investment in infrastructure, which should come in the first half of the year. So actually, some of the construction numbers might actually be all right in the first half of the year in Italy. Just keep a look at that. But in general, construction should do all right. And then we discussed the ECB. The ECB is very dovish. We're hearing the dovish comments are coming out thick and fast at the moment. But my point is, it's priced in. The markets is priced in. I mean, at this rate, we're going to start pricing in cuts soon, and bond yields are going to go negative, and that's just an accident waiting to happen. If that, I mean, that is, I think I would lean strongly against that, given where the general environment is in the global economy now and how skittish central bankers are with respect to nothing bad or going to happen. They're going to err on the side of throwing more money at it rather than letting it run out of control. And yeah, finally on the ECB, I still have a 20 basis point hike in the deposit rate in my forecasts for Q4. So just for the record, for the reasons that I've explained here. Obviously, that's now hanging like in a very thin thread. That's obviously clear. It depends a little bit on how much they downgrade their forecast in March, I think. And finally, on the political risks, Brexit is a little bit up and down. I think that's still mainly a UK issue. On the tariffs, which is really what I feel a lot of people are talking about at the moment, because it seems like that could be the next thing. I mean, Trump got the letter. German cars are security risk. That kind of, it seems like we've moved into an environment where that could happen. Sell the euro if we get that 10%. If we got a 25% hike, I mean, again, it's the curse. I mean, he'll win. Trump can win the trade war, but in a world of free capital mobility, he's going to pay for it via a much stronger dollar. That, I think, is the main lesson. And I think euro is sub 110 on that over a couple of days if that hits, because that's the equivalent of saying that the U.S. is an economy that's being cheated by the rest of the world and it's actually weaker when. And I think the market's going to take the other side and sell the euro on something that's it's going to be much worse for German automakers than it will be for Trump with those tariffs. That would be the way I would look at that. And I think maybe I will stop here. Again, if you have any questions, please write me an email. Call me. If you're listening to this on a replay, you have any questions, do the same. The phone lines are open at Pantheon if you're interested, and I'm just gonna leave it open for 1 minute, but I don't think that there are any questions. I had one question, so already answered that. That was about the underperformance in the external section. If you have any questions, you can type them in now, by the way. In the if you're logged in. So I'm going to keep it open for a couple of minutes, but otherwise I think that I'm going to end it. Yeah, you know what? I don't think there are any questions. There's no need for you guys. I've already spent an hour of your time. Thank you very much for calling in and taking your time. I really appreciate it. If you have any questions, let me know. Same thing if you're watching the replay. Thank you very much, guys, and I'll speak to you soon.